Are you working hard and building wealth, but wondering if your money is actually working as hard as you are? If you're an entrepreneur serious about creating financial independence, you're in the right place. Welcome to the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today I'm joined by Chris Larsen, founder and principal of Next Level Income. Chris bought his first rental property at 21, has been actively involved in over $2 billion in real estate acquisitions, and walked away from an 18-year medical device career because he built something better. That's the kind of story we love around here. Today, Chris is breaking down exactly how entrepreneurs can use real estate and alternative investments to build true financial independence, the kind that doesn't depend on you showing up every day. This conversation could genuinely change the way you think about your next financial move, so stick around to the end. If this show has been bringing you value, a quick review means the world to us. Now let's get into it. I'm excited about our episode today. We've got Chris Larsen on the show, and we're going to be talking about real estate and creating some income. How to be financially free by 40 is something we're going to get into as well. So Chris, thank you so much for joining us here today.
Absolutely. I'm excited to be here.
So when I think about the entrepreneur, they're almost focused exclusively on growing their income while neglecting the acquisition of cash flowing assets. And to build a successful business but fail to create a system that converts into lasting wealth, I think is it's a problem. And then internally, I think about the entrepreneur and they're wondering like, why don't I feel financially free? How much is enough? Am I building wealth or just generating an income? And what happens if I slow down or sell my business?
Yes.
Then what do I do?
Yes.
And then philosophically, successful entrepreneurs shouldn't have to feel like they need to work forever just to maintain their lifestyle. The purpose of wealth is not just accumulation, it's creating freedom. At the end of the day, we talk a lot about these most valuable things in life, and almost none of it has to do with money. It's relationships, experiences, growth, our contribution, and our health. We can dive into that in more detail if we need to. But I'm excited about how the work you're doing is supporting all of that. So thank you. Can you give us a little bit of your background? I think this is good.
Yeah, I'd love to, Patrick. And no, I'm excited to dive in because the same questions that you just talked about are the same things that I went through myself, that we worked with coaching clients on for years. And those are really at the core, especially for business owners. And, I know we'll get into that. But when it comes to me, I've been an entrepreneur pretty much my whole life. I really got into sales and I saw myself as a salesperson. But as I got older, I realized that it was really that entrepreneurial instinct. And I was looking for a career path that was entrepreneurial within, the traditional space. But my first quote unquote job was selling wrapping paper door to door at age 12. I had a paper route. I started a business where I would do lawns and rake leaves, and we lived in a fairly affluent area. We were in the blue collar area, but outside of Annapolis, Maryland, called Smyrna Park. And I could make $300, and we're talking 35 years ago in a weekend by, raking leaves and mowing a lawn or shoveling driveways, in the winter and snow. I went on to start selling Cutco when I was in college. I raced bicycles and I was raising money for our cycling team at 15. In college, I started, I would buy lofts back, like the wooden lofts from students. The girls, I would take them down for free. The guys would sell them to me for $20. I'd store them over the summer, and I'd sell them back to the students the next year for $100. So it was a very high margin business. Profit margins were like 80% gross. So always been an entrepreneur. Bought my first piece of real estate at 21. But, as I went through my career, Patrick, and, I was a real estate guy first. And then I got into med device sales because I needed money to fuel that investment path that I had. But what really, stood out to me, and I talk about this in my first book, and, if anybody wants to get a copy of both the books, you can go to nextlevelincome.com, and I'll give you a specific link for your listeners here for a free copy of our new ebook.
Great.
But the problem I saw, I was racing bikes. My best friend died when I was 19. He was 18. He was my training partner. He was about to be my roommate. He was like a brother to me. And I raced bikes for another year. And I had this epiphany, if you will. And I said, what am I doing? I'll never forget. I was in a race and I was in phenomenal shape. I was a category 1. My team went pro the next year. I quit that following year. I was winning a ton of races and I just felt hollow. I felt like nothing. And I was
Yeah.
like, what am I doing? Like, there's got to be more to life. And I just thought to myself, what if I die tomorrow? Like,
Mm-hmm.
will I be satisfied with the life I live? So I think that's really the first thing, that's
Yeah.
at the core of all this, Patrick, which is how do you intentionally create a life and a financial structure so you have freedom to do the things that are meaningful to you? It could be, as you were saying, like, I need to get healthy. It could be like,
Yeah.
for me, my boys are 16 and 14. I'm not going to miss a
Mm-hmm.
lacrosse game
Right.
with them. It could just be spending time and reconnecting with your spouse,
Yeah.
or as you get older, it could be giving back in terms of time and money. So,
Yeah.
I didn't know what I wanted to do at that young age, but I knew I wanted to create the structure to give me that freedom to be intentional about the life that I had and the talents that God gave me.
Yeah. So this is great, Chris. So I want to pause for just a second
Yeah,
because I think you're nailing all of this stuff. The whole goal of building wealth isn't to have another zero in the bank account, right?
correct.
Because at the end of the day, the money actually doesn't do us any good. It's
Yeah,
what the money does for us,
right.
right? Just having
Yeah,
the cash sitting there
yeah,
isn't that
yeah.
isn't that valuable. And so I just want to really quickly we touched on these, but you're hitting on all of them. So the reach concept, the most valuable things in life are come out of this. Ours for relationships. You talked about your wife and your kids, and I agree on all of those things. I've been married 24 years, way outkicked
Congratulations.
my coverage with my wife, high school sweetheart, get her to fall in
Oh,
love with
that's
you when she's
amazing. Yeah.
17 and doesn't know any better. It's the trick.
Lock her up early.
Uh, yeah, exactly right. And then I got three daughters. They're
Wow.
18, 16, and 13. It's a lot of fun right now. And um, my oldest daughter's a high jumper. I'm her coach, and
Oh, cool.
we've had a lot of success. A couple state championships. We're going to
Amazing.
nationals later this week, and
Amazing.
that's gonna be
Good
fun. And
luck.
like the time we, thank you, the
Yeah,
time we get to spend together is just it's so
it's
valuable. Like
magic.
my kids like still have an interest in what I have to say, and so that's kind of fun. So
Love it.
that's relationships. Experiences ties right in with
Yeah.
those relationships. Like let's do cool things with the people that we
Like
love.
raft the Grand Canyon.
Yes. Have you done that?
Yeah, and I'm sorry to interrupt, but I feel like this is the
No.
right time with
Yeah.
experience. So, yeah, when in 2018, and that's why I keep this picture in the back to remind me. One,
Mm-hmm.
it's when you're surrounded by 2 billion-year-old rocks, you start to really realize how insignificant you are. But the other thing I learned, Patrick, because I was running a medical device distributorship at the time, I was scared to death of being gone for nearly 3 weeks
Mm-hmm.
in total. It was
Mm-hmm.
it's a 16-day trip, but you got to get there,
Yeah.
you got to get on and off the river, so it's a 20-day total trip.
Mm-hmm.
And I never forget opening my phone. I was like, I'm going to have all these messages, and what are the
Yeah.
clients going to think, the customers going to think? And after 2 weeks, I had 78 emails I had to respond to. That was it. And what I
Mm-hmm.
realized was I wasn't that important. And
Yeah.
it was actually a very freeing experience. So for you entrepreneurs out there, if you structure your business properly, as I had to do before I left, and you're able to step
Mm-hmm.
back and let others, you hire that great talent, you give them
Mm-hmm.
the support to do what they do well. They feel valued. They like to do that. And
Yeah.
it really taught me something. It said, hey, I can be successful and still be valuable, even if I'm not in it every single
Mm-hmm.
day. And it was a really important thing. So I have that picture. One, it's really cool. It's
It
my
is.
favorite picture from the trip. But also it taught me a lot on that trip. And
Mm-hmm.
I have to look at that I get to look at that every day I come into my
Yeah.
office.
I love it. And the Grand Canyon was the first time that I understood awe. Like
Yes.
that
Yes.
you look at it and you're like, this is incredible.
Oh,
And I think about this amazing creation we live on, and
yeah.
it's like the Lord just was painting with his brush, more beautiful than anything that
Yeah.
I could ever imagine.
Yeah, that's no painting.
creating.
That's a
Yeah.
picture, which is
I
sorry, I got a
know.
little
Yeah.
reflection back there, but oh, it's incredible what we get to live
Yeah.
in.
Yeah, and I've had some friends that have also done the rafting tour, and if I'm not mistaken, I believe now, do you have to like enter a lottery to
We
get
had
on
to
that?
enter a lottery,
Yeah,
and somehow out of all of my friends that entered, I got it. So we were able to we
yeah,
coordinated a trip with 12 of us. It was a great
yeah,
trip. Yeah,
yeah. So I'm that is definitely on
put
my
it on the
list. So
list.
yeah, congratulations, and I'm excited for you, and I'm looking forward to that trip at some point. So this is great. So experiences are next, and they're things like rafting down the Grand Canyon. And then we think about advancement and growth, and we think about that on lots of levels. You talked about building a business in a way that allows you to leave, and we think about that in relationship to growing versus scaling. A scaling business is one that's not dependent on me, and I think that's an important piece, but I should be growing in as an individual. I should be bringing my kids along in that process, because if I'm going to transfer a lot of wealth to them, think about the curse of the lottery, right? If I have wisdom and money and I take away the wisdom, they soon won't have any money either. So
just like the Vanderbilts.
If I give them the money or the wisdom without the money, they'll figure out the money piece. So it's like that's a key piece. And then we move on to contribution. It's just better to give than receive. Scriptures tell us that. And then the final piece is our health, and we think about that from three components: our physical health, our emotional health, and spiritual health. Right? If you can't give me cancer for any amount of money, if I'm emotionally if I'm depressed and can't get out of bed, doesn't matter how much money I have. And if I'm spiritually bankrupt, it again doesn't matter. So we think about all of those things, like let's have our money support all of that. And so I think that leads us a little bit into your framework for financial independence. It's a cool acronym. I think we have a lot in common, and I think DIAL is that. So can you walk us through what that means and how we should think about this?
Yeah. So if again, and this is all, I walk through this structure, and we got a new ebook that came out. It's interactive. There's a lot of online resources with that. It's at nextlevelincome.com/financial freedom book. And I don't dive too deep into the things that we just talked about, Patrick, but I'm glad we got a chance to discuss it, because that's really the core. And DIAL is something that, for investors, investors come to me, they say, hey, we're interested in your multifamily investments, or, we were talking about our debt fund beforehand, and I always ask investors, hey, Patrick, what are you looking for? Are you looking for liquidity? Are you looking for cash flow? Are you looking for appreciation? You might be 35 and say, hey, I just want the highest return for the longest period of time. I don't need cash flow today. Or maybe you're 65 and you're saying, hey, I want to step back from my business or my career, and my wife wants to keep working, or maybe I want to keep working, my wife doesn't want to work. We need some cash flow to replace that. So DIAL and I use it not in this specific order, but because it spells a word. D is for depreciation, I is for income, A is for appreciation, and L is for liquidity. And you're typically going to get to pick two of those four. You might get three. You're probably not going to, if you get all four, it's probably too good to be true. So I think as an investor, you say, okay, what of those two categories are important to me? Let's say it's appreciation and depreciation, which is tax benefits, which I know you and your listeners are accustomed to. Then, hey, maybe a multifamily deal is good for you. If you want liquidity and income, maybe our debt fund, which is going to give you consistent income and it's going to give you the ability to get your money back, is more important. A lot of, people in the corporate world, a lot of our clients and investors, they're physicians, they're executives, they're salespeople that are making a ton of money. They don't need more income because they got a tax problem, which they should call you, and maybe you can help them out with that. But they say, hey, Chris, I don't need a bunch more income to pay taxes on. I need something that's going to grow at a nice, consistent rate. It'd be great if it gives me some income, but I want tax advantage growth. So DIAL, depreciation, income, appreciation, liquidity.
Yeah, I love it. So one of the things that I think is important in this discussion is, and this might sound silly, but can we define financial freedom?
Yes.
Because I think there's,
absolutely.
I see advertisements out there. It's like, oh, what's your number? And they're talking about like a wealth number.
Net worth,
and I'm like, well, guess what? It doesn't matter if I don't have the income. So I'd be interested in understanding your thoughts around how we define financial freedom.
Absolutely. And I know you haven't read the ebook yet, because it's by the time the podcast is released, it'll be out. But it's like you did, because this is the first thing I talk about. The traditional financial system, the retirement quote unquote concept, is broken. It's, hey, save a specific amount of money. You can withdraw somewhere between 2 and 4% safe withdrawal rate for the rest of your life and hope your money outlasts you. That's not how, it's kind of like the Dave Ramsey approach, right? Like no debt, pay off everything, save 10, 20%. I don't think that's true freedom. And the reason I say that is because my mom passed away in 2011. School teacher, great pension, great retirement benefits, great health care. She never got to take advantage of any of that. She was 57 when she passed away. She didn't get to go to all the national parks like she wanted to. She didn't get to see her second grandchild be born. So how do you get to the point of freedom faster? And it's not a net worth. That's the accumulation theory. Okay. What we teach and what I talk about in my book and what I did personally to become financially independent in my mid-30s is replace active income with passive income. And look, if you're a business owner, you might say, hey, I'm gonna grow my business into a business that runs itself. But what if you could have that and you could have income streams that cover your expenses? Once your passive income exceeds your expenses, you're financially free. That's the simple math.
I like it. And can we talk about passive income for a second? Because I think there's
bit of a misnomer.
I think
right.
And I think there's so let's talk about something that we both are involved in, and it's real estate. Okay. So I think one thing the misnomer around passive income when it comes to real estate is I'm going to go buy a duplex.
Right.
And I'm going to create some passive income. I couldn't think of a less passive income source. Owning a business is probably the most active, but when I start owning, when I buy a duplex, it's not big enough to put management in place.
Nope.
It's hard to buy something like a duplex and have enough margin to put management in place. So I'm over there hustling. I'm getting the unit ready. I'm mowing the grass. I'm showing the thing,
nice
whenever,
job.
Right. It is. And so that's what I think is an important distinction. It's like people think, oh, I'm going to go buy a bunch of single family homes and create this passive income. I think that is, the average landlord lasts 3 years before they're out of the game. And it's for that reason. They're like, I thought this is going to be like Amazon stock.
Calls on my honeymoon. Absolutely.
Right.
Yep.
Yes. So I think there's a problem with that. And so when we think about passive income, we're like, no, you need to find an operator. You need to find somebody that's really, really good at this game, and you invest alongside them.
Exactly.
And create the passive income that is going to come with that freedom that you're seeking. So I don't know if you have anything to add to that, but I think that's a key distinction.
I think you framed it great, but I do think one thing we need to be cognizant of, Patrick, is you need to be actively engaged in your financial picture. So whether you quote unquote give your money to a financial advisor, you still should understand what they're doing. You should be actively engaged with your tax strategy, not just have a CPA that looks at your receipts from the year before and files your tax bill. I have an MBA in portfolio management and finance. I spent 5 years reading 250 books on all things business and money and stocks and real estate. So I gave myself that education, but especially with AI now, you can go in and you can create like a virtual advisor to teach you. You can ask these questions. Hey, what should I know? But no matter how quote unquote passive your income is, you should always be engaged in where that money is coming from and take note in that. But yes, real estate is a business. I talk about that in my first book. We're buying apartments, but those are little businesses that have a bunch of clients every month that are paying us rent. And, there's employees, there's the manager, there's the, groundskeeper, there's pest control, there's, the contractors, all of that stuff. So it depends on how passive do you want to make it. But if you're too passive, things can get out of your control. And we see that with these professional athletes that just give their money to people and it disappears in a very short period of time. So, you want that income coming in, reliably, but you always want to be actively involved in any income streams you have.
Yeah, I think that's a really good observation, because we've seen this on lots of different levels. We've seen business owners that they think they have a management team in place and they completely check out, and then all of a sudden they're like, we've got a close personal relationship where business, thought we were on $1 million of profit, lost $1 million just with how all the accounting was done. Dollars were being shuffled all over the place because they were scared to death of like highlighting that they were mismanaging the business. And then all of a sudden it's like, oh, wow, I took my eye off the ball. Now I've got to get involved and go fix this thing. And even when you have a management company managing your property, you still have to manage the management company, you know,
Absolutely.
To make sure that you're getting the performance. Because at the end of the day, if you're managing the management company, they're going to respond to your property better than they are the guy that is completely checked out. And so that's the thing you want in that process. And so I think that's a fantastic observation. And the reality is when you build wealth, there becomes a responsibility to manage it and steward it well. You know, we can't just like hand it to somebody, abdicate that responsibility to somebody else, and then be surprised when it all falls apart or they acted in their best interest.
Yeah, and you kind of alluded to this earlier, Patrick, which is also, and then learn enough so you can teach the next generation about it. And that's the difference between, you know, the Vanderbilts. I'm here in Asheville, North Carolina, and the Vanderbilts basically squandered all of the wealth that Cornelius accumulated, being, you know, one of the richest men in the world at the time, you know, versus the Rockefellers that put rules in place and educated their generations. So, hey, just because you're not worth 100 million or $1 billion or $1 trillion, that doesn't mean you can't have the same rules and the same structure, which is what we teach.
Yeah, this is great. So I think it'd be interesting to dive into a little bit of we've touched on this, but like building wealth versus building cash flow. Because I can go buy a bond that's going to kick off a little bit of cash flow, and that's okay. But I think there's better ways. There's ways to get better return on your dollar. So can we talk a little bit about how to maybe optimize that income?
Absolutely. So I think the first question you have to step back and ask yourself is, okay, what creates true freedom? So we touched on that. You know, your quote unquote passive income, which we'll say is, you know, partially passive. Once your passive income coming in every month exceeds your expenses, then you have financial freedom. So in the book, in the ebook, I talk about, you know, number one, have a business or career that generates a significant amount of income. 2, live below your means. We advocate getting to the point of saving 50%. Now, what's really cool is if you save 50% after tax, if you invest that money at a 15% IRR over 7 years, at an 8% cash flow at that point, and we have examples in the book where this is, you know, very feasible, then you actually exceed your monthly expenses at 7 years with that formula. So if you're not there at 50% savings rate yet, that's okay. You can get to that point through tax savings. You can get to that point through increasing your income in other ways. But then the question is, okay, do I want to be worth, you know, $1 million or $5 million or $10 million or $100 million? Or do I want to have financial independence? If your goal is to be the richest person in the world, go like Elon Musk and work 20 hours a day and pour your heart and soul into your business. And God bless you, especially God bless people like Elon Musk for solving the world's problems. Certainly, but I don't think his goal was to be a trillionaire. I think his goal was to solve problems, and that just happened to be a side effect. But what I found, Patrick, is myself and working with others, if you focus on that initial point, which is generating those income streams to cover your expenses, you have more freedom to really focus on those things that are important. So you feel free, and your net worth is probably going to continue to grow anyway, just by virtue of those things. So if you're investing in the stock market, if you have, you know, a lot of equity tied up in your business, and you take a portion, you know, if we look at Tiger 21, which takes high net worth individuals, $20 million or more, and they survey them every quarter. Those individuals are putting 25% in the stock market, 25% into real estate, probably about 20% into private equity, 10, 15, 20% into private equity. And then they mix it up with some other alternatives as well. But if you can take a chunk of your net worth, a chunk of your income, and start to put it in investments that generate that cash flow, you know, that is a very reliable formula. And once you get there, then the beautiful thing is every extra dollar goes into either increasing your income further, increasing your net worth further, It can go back into, your business, philanthropy, whatever it is that's important to you. So what I found, and I'm always happy to be corrected, but I found that is the simplest and fastest way to achieve that goal.
Yeah, I love that. And one thing you highlighted that I think is really important. I've been reading the book Simple Path to Wealth by J.L. Collins to my daughters.
Yeah.
It started as a book to his daughter about like, hey, here's. It actually started as some letters to his daughter, and then it turned into a blog, and then it turned into a book. And one of the things that he highlights in there that I think is undervalued is maintaining a lifestyle that isn't too extravagant. Because the reality is, like, we get above a certain income threshold, it doesn't make us any happier to have more stuff.
Nope.
It just creates more complexity. I think there's actually a little bit of satisfaction that can come from just keeping our lifestyle at a certain level. Like there's, forgive me for this example, but the polo shirt that I'm wearing now, I have 21 of these, okay, in different colors. Exact same shirt. I'm just a robot. I like it. But
I'm very similar. So even our company shirts are the exact same for everything. So,
I love it. But I found out, I was like, okay, I don't know if I need 21 of these. And so I'd also bought another few pair of pants, and they're hanging up in my closet. And I'm like, holy cow. So I took 12 months, and I'm like, I'm going to see if I can not buy any new material stuff for 12 months. Just necessities only. Yeah. And I survived. But it was a really interesting exercise to just go through and go, oh, okay, cool. I can do this. I don't need to worship at the altar of materialism and buy more crap. Yeah. And so that was kind of a fun little exercise. And once you get there, you're like, okay, cool. I can live this way. And it allows you to get to that freedom. I promise you, freedom is better than more crap. And so, when our income streams, in that 7-year process that you outlined, can get to the point where we, are free. Now, if we decide to, we can go, great. We're going to keep accelerating our wealth. And now I can start to adjust my lifestyle up. But I have the freedom and flexibility to do that. So,
and that's, I think,
that observation.
That's a terrific point. And, when you kind of freeze where you are with respect to your expenses, it is freeing. You realize that, hey, this stuff doesn't really matter. Yeah. I love the experiences and reach, like you mentioned, those are much more valuable. That's what we try to do with our boys and our children. And, I don't know if I'm a full minimalist, but I definitely, it drives my wife crazy because I'm like, I just don't like stuff. I don't feel like I'm good at getting gifts. I'm definitely not good at getting gifts. Because if I need something, I'll get it. And if I don't need something, I don't have it. But then you are free to do those things. And then, when you do buy stuff, buying quality and things that are going to really drive experiences is much more valuable in our opinion.
Yeah. Hey, real quick, we heard Chris talk about using real estate and alternative investments to build financial independence outside of your business. And I want to know, what questions does that bring up for you? What are you wrestling with when it comes to your wealth strategy? Because here's the thing, this show exists for you, and I want to make sure we're bringing on the right experts and diving into the right topics that actually matter to your life and your business. So head over to vitalwealth.com/questions and drop your question right there. Whether it's real estate, tax strategy, passive income, or anything else on your mind, I want to hear it. That's vitalwealth.com/questions. Go ask your question. Let's make sure the next conversation we have on this show is one you actually need. All right, let's get back to Chris. So let's talk a little bit more about real estate. I think real estate's like the wealth engine. You look at people on the Forbes list. We've talked about Elon, first trillionaire to ever exist on this planet. So people get there one of two ways to the Forbes list. They do it through building a business or owning and building a real estate portfolio.
Top two ways.
Both. Yep. And so what you don't see is anybody on that list that stock picked their way to the Forbes list. If somebody had a better mousetrap for, investments, they'd be there. And
Nancy
so would
Pelosi.
Lots of other people.
Nancy Pelosi, right? Maybe.
Yes. That might have something to do with insider information.
Maybe.
But yeah, so real estate is a fantastic wealth engine. And so I'd love for you to just talk through that a little bit and how really our financial freedom can be generated through investing in real estate through the different forms.
Absolutely. And I'll try to keep it high level, Patrick.
Mm-hmm.
And again, if you're listening, you're like, hey, I want to learn more about that. I can share how you can get in touch with our team. But yeah, when I read those 250 books, when I said, hey, what's my path going to be towards financial independence? I said, real estate makes the most sense. I can buy a townhouse for $90,000. I control the price I go in at. I can I can put long-term debt on it. I can understand, the valuation, the cash flow today. There's tax benefits to it. I can force appreciation like in our commercial properties with income. There's other variables that matter as well, but it's just, that leverage gives you the ability to create a massive amount of wealth. Arnold Schwarzenegger became a millionaire through real estate. A lot of people don't realize that before he became, this massive action, film star. So, and there's a lot of different flavors of real estate. If you're young and you got a bunch of time but don't have a lot of money, buying a duplex, living in one side and fixing up the other side and renting it out might be a great option. I would buy townhouses and I'd live in one room and I'd rent the other two out. That's how I got started. They call it house hacking now. You can, we built homes, we built spec homes for years and did it that way. But, if you're in a career, if you own a business, my favorite path towards owning real estate is through partnering, like you said, with an operator. So that's what we do now with our investors. We do multifamily. We've done self-storage, car washes. One of my favorite areas right now is senior housing. We have a hard money lending fund. So we're originating loans through our partner for investors that are fix and flipping homes. And it allows our investors to basically be the bank so they can, have their money lent out at a nice high interest rate, not have to worry about, doing all that. So that's one of the other great things about real estate, Patrick, is there's all kinds of different ways to do it. If you're a business owner, I'd say my favorite thing to do is buy your business real estate. Now you have your business on one side, you've got your business real estate on the other, and your business can pay for your business real estate. Tremendous tax benefits. And then you can invest in syndications and you can use the depreciation of the syndications to offset the income that your business paid your business real estate business that you have. And it just becomes this virtuous cycle that you can continue on and on and on. So I think the best way to look at real estate, if that's not your primary business, is a very complementary business that's also an investment that can give you, a lot of those pieces of the dial that we talked about before: the income, the appreciation, the depreciation. Okay. And then once you do that, you can use the liquidity in the real estate to really help help things. We use cash value life insurance for liquidity for our family, which again is going back to the Rockefellers and doing that. So we layer in. We've got business, real estate, and life insurance as kind of those pillars.
Yeah. And I think not to wander off on a life insurance tangent, but I think about life insurance as a liquidity tool.
Yes.
And if I'm looking for 3%, 4%, 5% tax-free rate of return, and if heaven forbid anything happens to me, I get the leverage of death benefit. Like it is a very useful tool in the right situation.
Absolutely. It is a tool. It is a tool. Yeah. We can go down that path. But no, it's again, there's just because your real estate doesn't have maybe the liquidity you want, there's other tools that you can wrap around your business and real estate to solve for that.
I love it. So, Chris, I've been involved in lots of real estate opportunities. I think we're currently involved in about $200 million worth of projects.
Awesome.
You've had almost $2 billion worth of acquisitions in your career. And I've learned how to make money and lose money on just about every type of real estate opportunity out there. Because I think it'd be good to. There's a quote by, I think it's Conrad Hilton. I think that's where I first saw it was attributed to him. Was I don't do business with anybody that hasn't been bankrupt twice. Now I've been fortunate to not have been bankrupt, but really close lots of times with. We were investing through the real estate downturn in the late 2000s, and then so that's been fun. But we've learned a lot of lessons along the way. Um, and so I think an important thing about partnering with operators is somebody that's been through the mix.
Yep.
They've learned some lessons along the way, both good and bad. So can you just talk to us, because you highlighted a portfolio that's involved in, and I appreciate this. Like you're looking for the opportunities, whether that's senior housing property, and that's where most of our portfolio is currently.
Oh, awesome.
To self-storage.
Yeah.
And, my wife owns and operates the senior housing, business, and they have about 700 employees. I'm like, that's well beyond my abilities. But, so I'd like to just hear some of the lessons, maybe both good and bad of things that you're like, this has been my journey.
Yeah, absolutely. So, one of the things I noticed as my life progressed is that real estate goes in cycles. Stock market goes in cycles. Real estate goes in cycles. There's a great book called The Secret Life of Real Estate and Banking. And it talks about how the cycle lasts about 18 and a half years. And I remember watching my parents lose their jobs with a real estate company during the savings and loan crisis. Obviously, there's 9/11. There was the great financial crisis. We saw kind of the real estate go through a downturn, rise back up. We saw COVID. We saw the excesses during COVID and, the interest rate environment that was unprecedented, that had a big effect on commercial real estate. So, one thing, when you zoom out, I think the important thing is to understand that real estate goes through cycles, and that at different points in the cycle, different types of real estate perform really well. We started building spec homes in 2012 when the real estate cycle was at its bottom. You could pick up land cheap, building costs were cheap. Value add properties were a great fit after that as rents were rising and, rates were still low. As COVID hit, higher quality properties made a lot of sense. But as rates have risen, then you kind of go to the other side of the scale, and, being the bank is very valuable. So if you can lend money today at high interest rates because rates are high and there's a lot of equity out there in properties, potentially, it just depends on the asset, because there are distressed properties, which are a different area of opportunity. I think understanding, the different types of real estate and what performs during the cycle makes sense. So that's where a lot of people are like, why are you invested in all these different types of assets? And the answer is, I follow demographics, I follow, business trends in different states, but I also follow the real estate cycle, and I'm attuned to that. But I think one of the big things is investors are like, well, what should my biggest concern be? Like, what's the biggest risk? And I'll give you an example of a risk that illustrates that. It's as Donald Rumsfeld said, the unknown unknowns. I live in Asheville, North Carolina.
Yeah.
Office building, short-term rentals, car washes, single-family development. Helene hits.
Yep.
My tenants in our office, all 8 office units, stop paying me rent. Why? Because we can't supply utilities. There's no power and there's no water. Well, they don't legally have to pay me rent. What does the bank say? Well, Chris, we can defer your payments, but you still have to pay them. The insurance company says, well, this doesn't qualify. You have no property damage, and you have to pay your insurance. The city says, hey, we've got all this infrastructure damage. You have to pay your taxes. So I go from, a net positive return, to very quickly, having a lot of money going out every month, which is where that liquidity comes in. So I just highlight that because, no matter what you're invested in, no matter what you're doing, you could say, hey, this is a real asset. There's, it's very stable. But, life happens, things happen that we don't foresee, whether it's the interest rate or environment, or there's a hurricane hitting us here in Asheville. And I just want to say that because, whatever you do, you just have to be comfortable taking risk, and don't put all your eggs in one basket. So that's where, if you're a business owner and you're heavily invested in that asset, maybe you don't go buy, your own apartment building. Maybe you spread out $1 million investment over 10 syndications, for instance, in different areas. So you have to kind of be cognizant of what you're really focused on, what your level of risk is. And, again, going back, it's okay to have your money in different areas.
Yeah, and thank you for that highlight. We were actually working with a client that was making an acquisition in Asheville
Oh, wow.
when that storm happened, right? It was a business acquisition, but we were talking to the seller uh, from their cell phone, that they were charging off a generator so they could
Yeah.
like have this phone call. And it's one of those black swan events.
Yep.
Like
Absolutely.
Asheville shouldn't flood,
Yep.
right? But they
Yep.
had the perfect scenario with all of the rain that just sort of came in a unique way. And it's like, we can't plan for these things.
Can't plan. Yeah.
We just don't know. What we can do, though, is we can plan our liquidity. We can make
Yep.
sure we have safe amounts of cash. And this is something that we talk to our clients a lot about. We have a minimum threshold. The number one reason businesses go out of business is they run out of cash. So it's like,
Yep.
okay, cool. We are not going below that minimum threshold.
Yeah.
We also have a maximum threshold because we also
Yeah.
think that it's inefficient
Cost
at a
of
certain
capital.
point.
Yeah.
Right.
Absolutely.
And so I think sometimes there's too much value put on liquidity. I can go get better returns investing in a piece of real estate that is illiquid because of all of the things we've talked about in Dial that fit into there nicely. And it's like, yeah, I can't get my money back out, but that's okay. I've got my liquidity piece taken care of. Now I'm going to let these assets just continue to grow and generate wealth and income for me. So
Love it.
good.
Well said.
Thank you. So I feel like we could just keep chatting all day long. I'm curious about, we'll call it generational wealth. You've touched
Yes.
on the Vanderbilts and the Rockefellers. I
Yeah.
think that's important. Do you have thoughts on how we can build generational wealth and sort of bring our kids along in the process and sort of keep this thing going on a Rockefeller type trajectory versus like running out over by the third generation?
Yeah. Shirt sleeves to shirt sleeves in 3 generations, right? So it's one of the things I'm most passionate about, Patrick. And, with my boys being 16 and 14 now, it's like, okay, you're listening, you're making a lot of money, you've grown your business, you've invested. It's like, okay, we're worried like, well, what if our kids squander it? So the first thing is you need to start having those money conversations, at the appropriate ages. We started paying our boys at a young age. We gave them $1 a day, and that they had to do their stuff around the house. If they, didn't listen to their parents, if they talked back to their mom, if they left the lights on, they didn't get their $1 because they didn't do their job, right? It's like, it's important for our kids to understand that they have responsibilities as part of the family. My kids, they didn't get like mac and cheese and chicken nuggets every night. They ate what the family was having for dinner. So I think, at the very foundational level, you teach your children that they're part of the family, and that has privileges, but also has responsibilities. At nextlevelinCome.com/kids, I wrote a chapter for a children's book, or a parenting book. So it's 5 lessons on money, and that's one of them, pay your kids. I'm not going to go through all of those here, but then, let's talk about, you were just talking about cost of capital to businesses, like having cash sitting there, there's a cost to that. Well, there's a cost of capital. So instead of giving our boys, say, $200,000 for college, they're going to be able to take loans against our life insurance at a favorable interest rate. And maybe or maybe not, they'll have to pay those back. And as far as they know, they're paying them back. But they have to understand that there's a cost to that money. So if they're gonna spend $200,000 to go to college, they need to understand that they better get a return that exceeds not only the $200,000, but the cost of that capital, which could be going elsewhere. Once they learn the value of that and they show the responsibility, then they'll have access after paying that money back to use that for businesses, real estate, other things in their life. So that's kind of the other end of the spectrum. Teaching your children the cost and value of college, which we have up there. But then, if you have a business, I've taken my boys to business meetings from a very young age. They sit in, they visited properties, they've shipped out, our books to, people. They wash our company cars. My older son has his license. He can be my chauffeur now, which pays pretty well. Nice. It costs $50 an hour to hire a driver. So I can pay him. Now he can put money into a Roth IRA. So now they're starting to understand, hey, this money in my Roth IRA is growing because of that. So we've started with very simple money conversations, responsibility conversations. Now we're getting into things like, hey, what's the cost of capital for college? My younger son is like, hey, I want to come work with you in your business. It's like, okay, well, I said, well, if you want to do that, what are you going to bring me? You know,
Mm-hmm.
I'm like, if I got money, like, what do I want? He's like, oh, deals. I'm like, well, you know, you need to go learn how, like, what a good deal looks like. You know,
Yeah.
learn how to evaluate a deal, learn how to evaluate a business, a piece of real estate, those sorts of things. So if you're listening and you're nervous, you know, with respect to teaching your children about money, start wherever they are at whatever age it is.
Mm-hmm.
That might just be taking them to the bank and,
Yep.
you know, depositing money in the bank. That might be buying them a little accounting ledger, like I talk
Yep.
about on that website, /kids at our website,
Yeah.
and recording that in there to understand that. They might be getting them a green light card, like we got our boys. So they put their earnings on there. They spend their own money. You know, if they have to buy something, they do that. My older son
Mm-hmm.
plays lacrosse. He wants to be a D1 lacrosse player.
Yep.
We have a recruiting consultant we signed up. It was almost $5,000. He's paying half of that. So he's got skin in the game. So,
Yeah.
you know, don't be afraid to get your kids involved. And then, you know, if you're working with an estate planning attorney, if you're working on setting that up, you know, that group should bring your teenage children in at some point and start to educate them on the process. And there should be hurdles that they go through before they have access to that family wealth. And I think if you do all those things, it might not be perfect. It's not easy, but you can, if you have employees, you know, treat them like a, you know, like a familial employee, and help train them and get them to where they can be good stewards of the wealth that you've created.
That's fantastic. Chris, I feel like we could have a whole nother episode just on our kids, because we've done so much of this with our kids as well. We started off with what we call the family bank, and they had a little check ledger, and it totally eliminated the, can I have this? Can I have this? Can I have this? It was like, hey, you've got your money to spend. So do you want to allocate your dollars to that plastic piece of crap that you're badgering me for? And they quickly decide when it's not dad's money, they're not that interested. So
it makes a big difference. And let me take, if I may, because this is important. My son is playing basically lacrosse full time and training full time this summer. And because we're back and forth between Charlotte, which is 2.5 hours away, and where we live, he can't have a job like he did last summer, but he has a job. He has to get up at a certain time. He has to do a certain amount of schoolwork every day, kind of like to keep things going. He has to train. He has to, so he's got a job that he has to do. And he knows if he doesn't do that job, then he has to start paying for certain things. So, you know, it's, again, even if we're not using the money, I think we can teach our children these lessons to, you know, not only be good, you know, employees per se, but really understand how to take control of their outcomes.
And what you're talking about is responsibility. And we talk a lot about this in our household, able to respond to the situation, right? So like right now, your son's responsible for getting himself up and doing all his training and all of the stuff that comes along with that, right?
That's right.
And if he's not responsible, it's going to cost him something. That's very much how life works.
I love it. Love it.
Chris, this has been a lot of fun. I think you've highlighted a few opportunities for people to get plugged into your resources, and we'll have links to all that in the show notes. But nextlevelincome.com is a place that people should absolutely start. The ebook is great. The opportunities for kids that you've outlined are also great. So can you outline, like, okay, I'm listening to all the cool things Chris is saying, and I want more. What's the best place for people to get connected to you?
Yeah, I'll try to be concise. So nextlevelincome.com has all the resources. If you're interested, we just talked about the kids topic, Next Level Income /kids. That's our 5 rules to set your kids up for money success. If you go to Next Level Income /financial freedom book, that's where you can get a free copy of our new ebook. And if you said, hey, Chris, I am interested in learning more about different investment opportunities that are out there, click on the invest link, and that'll allow you to schedule a call with our team, learn a little bit more about what we have in terms of offerings out there for passive income to increase your reliable streams of income coming in every month.
I love it. And the cool thing is on the homepage, as it stands, there's links to both the Next Level Income book and the being able to invest right alongside Chris and their team. So go check it out. They're just a wealth of resources there. Chris, this has been been fantastic. I think about the stakes, right? If we don't take action on these things,
Yes.
I'm me and the entrepreneur in general, they're stuck relying on their earned income. They remain dependent on that active work. Any business setbacks could threaten their lifestyle and their security. And we think about what you're doing with the depreciation and all the cool ways we can create really efficient income through real estate. Taxes can consume a larger portion of that wealth if we're not careful. And then retirement could be uncertain, right? And I think a lot of the entrepreneurs, they're not really excited about necessarily retirement, but they're excited about freedom, and I think they relish the opportunity to sort of be disconnected from the business or sell the business, but still be able to have purpose and meaning. And I think about the stewardship of the wealth that they've built is a key part of that. And you highlighted that when we're talking about like, hey, you got to keep your eye on the ball to keep these things going. And so
absolutely, well said.
We don't want that wealth disappearing within a few generations. And so like that's the stakes if we fail to take action. And I think about what happens if we do this. Work becomes optional. Who doesn't love that idea? The financial stress just starts to melt away. Taxes become more manageable. Wealth is compounding faster. Family legacy extends beyond just our lifestyle. We're not consuming it all. We're building responsible kids that can handle the stewardship of the wealth as time goes on. And our freedom we're just opened up in so many different avenues of freedom. And this is exciting. I appreciate all the opportunities that you're creating for the entrepreneur out there that has the dollars to invest, that is looking at building their wealth and creating some income.
Well, Patrick, thank you for having me on. And hopefully if you're listening today, you got something out of the conversation, and wherever you are, we've got something hopefully for you to help you on your next step to financial freedom.
Wonderful. Thanks so much, Chris. Thank you so much for tuning into today's episode. I hope our conversation with Chris gave you some real clarity and fresh perspective on what's possible when you start putting your money to work the right way. If this episode brought you value, do me a favor and share it with a fellow entrepreneur who needs to hear this conversation. You never know whose life you might change with one share. If you haven't already, leaving a review takes less than a minute, and it helps us reach more entrepreneurs who need this information. We'll be incredibly grateful. We'll be back next week with another conversation designed to help you think bigger, build smarter, and live better. So make sure you're subscribed and ready to go. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. You're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.